Hello there. Welcome to this online lecture where we're going to be looking at one of the key areas of the Level 3 AAT qualification. We're going to be looking at incomplete records, which is part of the syllabus for the Preparing Final Accounts for Sole Traders and Partnerships paper under the new qualification, and it's still relevant to the AP2 paper under the old syllabus. Well, my name is Gareth. See my contact details there, so feel free to email me, garethjohn@fi.co.uk. I'm a managing director with First Intuition, one of the UK's leading AAT training providers. In the last few years we've won a series of awards we've been very pleased with. So we were UK Accountancy College of the Year in both 2010 and 2012. I was extremely pleased to be awarded UK Accountancy Lecturer of the Year in 2011. More recently, we were nominated for Study Resource of the Year in 2013. Well, in this online lecture, we're going to be thinking a little bit about incomplete records technique and how to derive sometimes missing information. A little bit of a detective hunt almost of using information you do have to derive information you might be missing. Now, incomplete records techniques are particularly useful in small businesses where perhaps their accounting system isn't completely robust, perhaps their nominal ledger isn't 100% accurate, maybe they sometimes record items, maybe they sometimes ignore items, maybe they keep certain records and they lose certain records, and so very useful particularly for small businesses and quite a key part really of this unit of the AAT qualification. So let's have a look at what we've got here. Well, we're given some information here at the 1st of January. So at the beginning of a particular year, we're told that they had outstanding trade payables of £15,000. That's what they owed to their credit suppliers at that point. And they had inventory of £20,000. So that's their opening inventory, the units they had in stock at the beginning of the year. So that information is from the start of the year. We're told that then during the year, sales were £500,000. And the business earns a consistent margin of 20%. Now, margins are telling us a little bit about the cost structure of the business. And if we know their margin, then we can use the sales figure to actually derive what their costs must have been. But we'll come to that shortly. We're then told there was a bit of a disaster. There was a fire in the warehouse on the 31st of December, which destroyed all units of inventory. Now you can imagine the 31st of December is the end of the year, so the units that would have been in inventory on that day would effectively be the closing inventory at the end of the year. If you remember, we knew what the opening inventory was. The opening inventory at the beginning of the year was the £20,000, but in terms of their closing inventory, we don't know what was there because it's been destroyed. But we do know some other figures. We know that trade payables at the end of the year was £19,000, and we know that during the year, payments made to suppliers were £412,000. So we've got some other bits of information here. And the whole point of this is to use what we do know to identify what we don't know. So we can work out the value of inventory destroyed in the fire using some of our incomplete records techniques. Now, incomplete records techniques can involve 2 or 3 different elements. And I've actually designed this task to show you 3 different incomplete records techniques that can be useful for helping to derive missing information. The first technique that we can use is we can use ledger accounts or T accounts. For instance, in the information we're given in this task, we know what the trade payables balance at the beginning of the year was. We know that at the beginning of the year they owed their suppliers £15,000. We know what the trade payables balance was at the end of the year. We know that by the end of the year they owed their suppliers £19,000. And we also know what the payments made to those suppliers during the year were. And we can actually take all of that information and start putting to an appropriate ledger account. In fact, the appropriate ledger account that I might use here would be the purchase ledger control account or the trade payables account, because that's recording the total amount owed to our suppliers. Now, if I take the 3 figures we know and put them on the right sides of the control account here. So the opening balance at the 1st of January, well, remember your purchase ledger control account or the trade payables balance is a liability, isn't it? So the opening balance would be brought down on the credit side at the 1st of January. That's at the beginning of the year, the £15,000 they owed at the start of the year. So but what I'll do is I'll sort of tick off the figures I'm using as I go along here. We also know what the closing balance was. Now bear in mind that the closing balance on any T account goes on the opposite side to the opening balance. So at the 31st of December, the carried down balance that we still owed at the end of the year was £19,000, and that needs to go on the debit side. Because if you imagine when we transfer that down to the beginning of the following year, that would get transferred over to the credit side. So remember that the closing balance or the carried down balance at the end of the year will always go on the opposite side to the opening balance. So I've got my 15,000 and my 19,000 in. The other figure that would affect the purchase ledger control account is the payments made to the suppliers. If you make a payment to your suppliers, that reduces what you owe them. And so we therefore have a debit entry on the purchase ledger control account. We would debit the purchase ledger control account by £412,000. The other side of that double entry would be a credit to cash. You can imagine we've paid that amount of money out. And if I tick that off, so I've now taken 3 figures from the information we're given into my purchase ledger control account. Well, why is that useful? Well, I can now balance up my purchase ledger control account to identify a missing figure. The missing figure in this case would be the credit purchases that we've made from those suppliers, because the credit purchases that we've made would be an entry on the credit side of the control account because it would increase the liability. Now, if I look at balancing up my T account here, you can see we've got way more on the debit side. In total, I've got 412,000 plus 19,000 on the debit side, which comes to a total of 431,000. You can see on the credit side at the moment we've only got the 15,000 entry. So if I put the 431,000 in both totals, remember you've got to make the scales balance. I think of the T account like a set of scales. The debits and the credits should give the same total. But obviously at the moment the credit side doesn't equal 431,000. So what's the balancing figure that I'd need to insert? Well, to make the 15,000 up to 431,000, I think I'd need a balancing figure of £416,000. So you can see, using a little bit of cunning, a little bit of detective work, I've managed to identify now a missing figure. I know what the level of credit purchases during the period was. Well, why is that useful? Well, the other incomplete records technique we can now start thinking about is the makeup of cost of sales. Now, hopefully from your studies of the income statement or the P&L, you're familiar with the concept of cost of sales. And cost of sales is generally made up of 3 elements. You'd have opening inventory at the beginning of the period, plus any purchases you've made during the period, then deduct any closing inventory that you've still got at the end of the period. If I took those 3 elements and combined them, that would give me my cost of sales. The reason you deduct the closing inventory is obviously if it's still in inventory at the end of the year, you haven't sold it. So it shouldn't therefore be part of cost of sales, which is why we deduct it. Well, we've actually just identified the purchases figure, haven't we? So I can actually now bring the purchases figure across. We know the £416,000. That can become part of my cost of sales calculation. Well, what else do we know? Well, if you remember, we knew the opening inventory at the beginning of the period. We knew that at the 1st of January, we had £20,000. So in fact, I can add that in as opening inventory of 20,000. Again, I'll tick the figure just to remind myself that I've used that information now. If I knew my closing inventory figure, we would knock it off to therefore give my cost of sales. But if you remember, the whole point of this is we don't know the closing inventory. This is what was destroyed in the fire, wasn't it? And in fact, that's the figure I'm now trying to work out. I'm trying to identify the closing inventory figure. Now, given that I know opening inventory and purchases, if I was to be able to establish what cost of sales was, I should be able to work out what the closing inventory figure would be. Well, how can I identify the cost of sales figure? Well, this is where I can now use my knowledge of the cost structure of the business. We were given the margin, weren't we? Now, there's two forms of cost behaviour that you might need to deal with in the assessment. There are margins, as we're looking at in this task, and there are markups, margins and markups, and make sure you're clear on the difference between the two. And really the difference is about the relationship between the sales figure you've generated, or your income figure on your P&L, the cost of sales that would then be deducted from that, and the gross profit that would then be left. You can imagine if your sales is £100, cost of sales is £95, that leaves you £5 of gross profit. And really the margins and markups just tell you a little bit about the relationship between these elements. Now, the way I always remember it is I try to remember what margin and markup are short for. Margin is short for margin on sales. And what that means is whatever your margin is, so the example we're dealing with gives us a margin of 20%. That means that the gross profit is 20% of something. And if it's a margin on sales, it means it's 20% of the sales figure. So the sales must therefore be 100%. You can imagine to get from 100 to 20, you'd be knocking off 80%. So the cost of sales must be 80% of your sales figure, leaving you a gross profit of 20%. So you can see with a margin, it's a margin on sales. So it's 20% of the sales figure. Markups, on the other hand, is short for markup on cost. Because you can imagine you take a cost figure and then you mark it up to decide how much you're going to sell for. So if we were dealing with a 20% markup, I'd still put the 20% where the gross profit is, but the 100% would be where cost of sales is, because it's a markup on cost. Now that means that the sales figure would have to be 120%, because 120% less the 100% cost of sales would leave you 20% gross profit, wouldn't it? So you can see you've got the same 20% for the gross profit. It's what that's 20% of that differs. With a margin, it's 20% of the sales figure. With a markup, it's 20% of the cost of sales figure. Now, in our example that we're dealing with, we're using a margin. So let me get rid of my markup stuff because that's not relevant in this example, although you may well see examples that do that. Now, what we can do is we can take the percentages I've set up in my little template there, and I can think about how that translates to pounds, because we know the sales figure, don't we? We know that the sales figure is the £500,000. So if I now use that, I can put that in as the sales figure. And actually, because I know the cost structure, I can actually work out the other two figures, because gross profit would be 20% of the sales figure, and 20% of 500,000, so it's multiplied by 0.2 or by 20%, is 100,000 gross profit. What does that mean the cost of sales would have to be? Or what would you knock off to give 100,000? I'd have to knock off £400,000. Well, the other way to think of that is if you take the 500,000 sales and actually multiply by the 80%, you should get 400,000. So you can see we knew sales. I now know cost of sales and gross profit. In fact, what I'm particularly interested in is that cost of sales figure. So if you remember, we were playing around with cost of sales. We knew the opening inventory and the purchases. I now know that the cost of sales figure is 400,000. Now, if you look at the cost of sales calculation, if you took opening inventory of £20,000, then added on the purchases of 416,000 that we got from the purchase ledger control account, if you add those two up, that would give you 436,000. So what would you need to knock off that to take you to 400,000? Well, I'm thinking that I would need to knock off £36,000. You can see I'm almost using a little balancing figure approach, working out what would the value of that closing inventory need to be to take the cost of sales back to 400,000. And so I've now identified how much inventory was in the warehouse when the fire destroyed it by my process of incomplete records here. And you see I've actually used three techniques here. I've used a T account for a control account here. I've used my knowledge of the cost of sales calculation, and I've used my knowledge of cost structures, the knowledge of the margin in this case, all to help me work out the closing inventory figure, the value of the inventory that was destroyed in the fire on the last day of the year. Well, I'm hoping you found that useful. Do practice incomplete records techniques. They are quite challenging, I think. That's why I thought an online lecture would be useful. They are quite tricky, but a bit of practice will help you to work your way through that kind of process. So I hope you found that useful, and I'll maybe see you next time. Thanks.